So maybe I have a couple of questions more from the markets at the moment.
Yeah.
And first question is from Shri Gandhi that, we have observed that quant multi-cap flexi and a small cap has fallen less compared to the benchmark, compared to the category average. Can you share the strategy deployed to arrest this fall and your views going forward?
So, as I explained earlier, also we were relatively early in identifying the risk off period, and and when you are 6 months ahead, sometimes that also hurts you, and which was the case in 2025, particularly 24-25 financial year, we have impact. But as I said, in last 2 quarters particularly, and last 1 quarter in particular, we have actually revamped our portfolio because we spotted that when we underperformed, the underperformance largely came on the mid cap side. Our risk strategy was right, but the stock selection was not apt, and hence we have revamped the portfolio. So revamped portfolio has really helped us a lot. And let's say today, I'll give you a small example. In last 3 months particularly, where we have seen a very severe fall in the large cap names also. Look at example like ITC was 10% down. Okay, and it's not a small company. So company like ITC or this Indigo was sharply down. Sun Pharma, Eternal. I'm just giving you a few example. Some of these, the most liquid large cap name Nifty stocks were down 10% in a single day. And some of these names, most of these names were not there in the portfolio. That's a more from a risk perspective to help us. So the portfolio construct was far superior, and we were relatively more skewed towards FMCG, more skewed towards power has done extremely well. As I said, in our multi-asset of Flexi Cap account, we have very large 25 to 30% pharma exposure. Oh, sorry, a power exposure. So that is also one of the reasons we have done better, and you have seen power has done better in the market. So it's largely more from a stock and the sector which we have. It has really helped us.
Thanks, Sandeep. And a quick, there is a follow-up part B again from the Shri Gandhi only that you have exited from the IT and pharma. So, what is your views on these two sectors? Because it may cover many more questions actually.
So, see, pharma, we have not exited. Yes, we have exited the formulation-based companies because that was our analytical view that we like to remain on the largely on the generic side, and particularly the global generic company because they are the biggest beneficiary in today's context. So we have that exposure. We have very large exposure in some of these names, and it's a skewed exposure. Second sector you talked about IT. If you recollect, right from September 2021, we have talked about the sector has peaked out, and since then we have been a very negligible weight. Even currently, also in between, when we saw a buying of a trading opportunity, we have participated, but we have pruned down much earlier than this fall. So our concentration within the uh, IT space is predominantly Oracle Finance in our portfolio, which is a product company. Our view is still cautious in this space, though valuation wise, they are very attractive. Okay, they are very liquid names, so we don't have a liquidity related challenge. The only thing is that uncertainty is still there. How this AI related challenge, I'm sure some of these companies will emerge as a AI enabler also. So we should do well. So we think they are closer to bottom. But if you ask me whether all data points have come to go all out and build exposure, and answer is no. uh, yes, they are now in the neglected territory, but let them come to the extreme one, and maybe at that point in time, we'll like to reassess that thing. As of now, we have not built exposure.
Thanks, Sandeep. Next question is from Ketan Ahuja that sector or thematic funds to be overweight uh, during this time out of the quant mutual fund entire thematic fund baskets.
See, frankly speaking, we as a house, obviously being a manufacturer of the product, we like to have all the products. But we as a house never try to push the thematic funds because of pure concentration risk. But if you really ask me in today's context, pharmaceutical is a theme which we like. and I think has opportunity. Though we are not pushing it since you asked this question, so I'm replying to you. That looks a better thing. And within we talk about second scheme should be large infra names. We talked about the power sector, so infra can also be a thesis which you can look at. And obviously, the FSI is largely evergreen thesis. So these are the two or three names if I have to say to put money there. Otherwise, the best opportunity should be on the flexi cap side or multi-asset strategies. Okay. Or even this time is apt to increase your exposure significantly in our small cap fund. Because I said Smith is giving you signs of capitulation. Last 2.5 years, we were bearish on this. And this is the first time we're talking about a very constructive outlook on the equity space and within equity, the small cap.
Thanks, Sandeep. I'll take one question by Vivek Kolte that, what is your views on the quant manufacturing fund and um, how the, things can change in the portfolio over a period of time in the
See,
quant manufacturing fund.
we have made lot many changes, I said in the presentation, but you have to keep in mind currently industry is facing challenges on the manufacturing side. And obviously within the manufacturing is a thematic fund, you have to keep a majority of the scheme, 80% has to be on the manufacturing side. So as compared to other large or mid or maybe the flexi cap, it has a potential to underperform because given the compulsion that manufacturing is has facing some amounts of headwinds in the current environment. Long term perspective, there is no problem, but if somebody look at just 1 quarter perspective, or so I think that's a we have to look and understand the environment which we are in. But still, we are happy what changes we have made in the portfolio, and if need, we will make further changes.
Um, Sandeep, next question is from Avinash and maybe Ankit Savla, one more. I'm not able to find the name. Actually, they want to understand that how the business cycle fund will perform here onwards, as the fund has not done well in the last 1 year. So, what is the strategy we are implementing to look into this fund?
Okay. Uh, so again, I explained, yes, we into 24-25 we did have a good amount of underperformance. We have made those changes. And that's the reason you see last 6 months it has improved, last 3 months it has improved. So it is on the improvement side. And given the thematic thing, we don't recommend, but business cycle is one fund which is relatively more balanced than the thing. If somebody wants to put money in the any of the thematic fund which I talked about, that's a very skewed structure. I mean, business cycle gives you a better diversified from a risk profiling point of view. So I think the direction is right. It has improved. Yes, we agree. It has underperformed in last 1 year, but it's now making changes. So you have to look at change what is happening in last 6 months, last 3 months, and and last YTD basis of this year. You look at we are seeing signs of improvement there also.
Uh, Thanks, Sandeep. Pratul wants to know that silver returns compared to the Indian markets return, if the horizon is for 3 years. I don't know if you can answer this, but what is
Come
your
again. Can
expectation?
you just repeat?
What would be the returns given by the silver compared to the Indian market? So, do you have any views
We
on
have
that?
answered that in 3 years perspective, silver will underperform the Indian equities. So I've said as a part of our slides, the precious metal or gold will outperform and gold underperform the equities, then silver by default will underperform. Maybe ratio can, margins can differ a bit, but silver will also. The entire precious metal has a potential of underperformance going forward as compared to equity market.
Okay, so Sandeep, couple of questions from maybe I'll come back to the mutual fund question, but the what is the taxation of this NFO? So the taxation of the NFO is the other category, which is equity will be between 35 to 65%. So this is for the Iqbal Singh. Rajesh Gada wants to know that what is the high frequency data and how it is useful in managing these funds.
So it's a good question. And let me just explain you like in a mutual fund when we we invite investor to put money, we always talk about a longer term perspective that anybody should have 5, 10 years exposure perspective to invest money, particularly on the equity side. So it's a long term thing. And since the product is slightly long nature, and we also are dependent on the data, which will, let's say in mutual fund, what we look at the earnings, which is quarterly. Some of the companies' data comes on monthly. So either we have monthly data or quarterly data or half yearly or yearly data on the macro side. So all these data points are coming with with a lag effect and the frequency on the lower sides, and hence they are known as low frequency data. And any analytics which you do, let's say balance sheet analysis you do, or sector everything, or the P&L account, cash flow, everything is a low frequency. So these are low frequency analytics, which is the reason we say now in mutual fund scheme, we 70% do low frequency analytics and 30% is high. When it comes to high frequency, which means anything which is frequently getting updated or getting changed, let's say weather condition. Okay. Med department, every daily basis we forecast. So Med department data on the weather is high frequency data. Okay. Second thing, when you trade in the market, volumes data, delivery data, price data, okay, these are all high frequency, minute to minute, or rather trade by trade, it's changing. Where on the fundamental side, your earning seasons and everything comes only on quarterly, though the company is doing turnover on minute to minute basis, but they don't share the data on live with you. Hence, the frequency is lag. So when we talk about, these are some of the example of high frequencies, all the derivative data, whether it's a volume data, open interest data, okay, or anything related to option pricing, wall service, all are largely high frequency. Anything related to high frequency, obviously known as high frequency analytics. The point which you have to understand, in the QSIP type product, we say we like to run in a conservative manner. Hence, we would like to control the risk. So if somebody, let's say, I have a 10 years view, let's say five, forget 10 years, I have a 5 years view on the equity market. Can I quantify the five, what will happen in the next 5 year? Answer is very difficult. So when we say that in QSIP we want to run low risk product and risk should be in a better control, then the whole thesis changes. We have to spend concentration of the portfolio will be only on the short term and medium term, because only in short term and medium term you can visualize the risk far higher than 5 years and 10 years perspective. And hence the entire thesis of QSIP, when you try to control the risk, okay, and hence we are more dependent on high frequency analytics rather than the low frequency. That's the reason in our QSIP portfolio we say 70% will be high frequency and 30% low. Now high frequency analytics, we are also evolving. We were the first to get our high frequency strategies we used to run in the HFT in the past, in our previous avatar when we used to run a very large prop desk. Now we are rebuilding that data because this QSIP product, that's the need. And more improvement will happen as we are able to stabilize these data points. So it's a approach different. We think we don't want to run QSIP like a mutual fund. The approach is completely different running the both the products.
Thanks, Sandeep. I think Mr. Gopi Chand wants to know that can we switch money from our liquid fund to SIF? To this, Mr. Gopi Chand, the answer is no. You cannot switch money from the mutual fund scheme to SIF directly. You have to maybe either have to redeem and then put the money back into the fund. But direct switch is not possible at the moment because, as per the SEBI guidelines, we are maintaining the separate database for SIF and mutual funds, and there is no interchangeability of the databases. Sandeep, next question is from Ashish Jain, and maybe I'll wrap up in maybe another two more questions. Maybe as advised by Sandeep, recovery is expected in the month of April. Based on that, have you increased your equity allocation in multi asset fund?
So it is across the board. Let's give you small example. We were sitting on between 6 to 18% cash, depending on the schemes. Now the cash level average has come down to 2 to 3% only. So we have actually deployed a lot in last 1 month, particularly in this fall. We have been a buyer, so our equity exposure has increased. But if you're talking about multi-asset, it also has increased, but not up to that extent because multi-asset DAF And hybrid fund, we don't go to the 100% mark on the equity side exposure because we try to showcase as a relatively low risk product. So even there also it has increased. So depending on the type of mandate which we have and how we run that scheme, accordingly we have made those changes. Like example, FlexiCap was sitting on 18% cash. Today is only 3%.
Thanks, Sandeep. As you have mentioned about DAF, there are multiple questions on the how the fund DAF is, performing at the moment, or maybe going forward, what strategy you are planning to put into that, based on the scenario at the moment. Environment is very volatile.
So DAP, if you look at, see, we run DAP very differently from the industry on the BAF side. And that's the reason if you look at uh, the performance in the inception of the fund, I think it is in the top quartile. It could be the number one in that category. If I look at from the inception dates, okay. The way we look at is that we don't run like a traditional BAF people run is like 40% in the equity exposure, 35 to 40% exposure, and remaining thing is arbitrage position. We don't run our DAF that way. Our DAF is the name itself is non-stored balance advantage. We use dynamic asset allocation thing. We play largely on a risk on risk of cycle. As let's say today, if we believe that risk of cycle is going to increase, we increase our equity exposure. As of now, it is closer to 70% mark. It was 65, now it is 70, 72% sort of thing, if I'm able to recollect correctly. And as data point changes, we try to cut down. So we are not running a balance advantage type structure. It's a pure equity product, and it is, yes, it will be relatively less risky as compared to other equity schemes. But the approach is more from a macro perspective. When we see a risk on opportunity, we try to capitalize. When we say as a risk, or we cut down our equity exposure, that's what we have been playing, and this is the way we have been managing that. Going forward, also, it will be approach will same, but if need be, we will start using more derivative options in the market because market has become very, very liquid now. So that's another area which can only help us in improving the returns.
Sandeep, last two questions, and I will ask it in a one go. One from the mutual fund, which is performance based, and one is generic on the SIF. So Keshav Sood wants to know that why did commodity fund not perform in line with the commodities? So what is the reason for that, and your outlook on the commodities? And second question is from the Smith. Want to know that, um, will the SIF outperform mutual fund schemes in the horizon of 10 years?
Okay.
So two questions, Sandeep, maybe
Yeah.
last question.
Yeah. First, on the commodity side, if you really look at the beginning of the fund, it was one of the best performing fund in the actually in the industry and then in that category also. So, but if you really look at in last 1 year when this trade challenges came, though the metal index has done extremely well this year, it has been one of the biggest outperformer in the market. If you're talking about NSC metal index or BSC metal index. But in last 1 year, since we were slightly more conservative on the macro side and we were worried about trade war challenges, we have not participated up to that extent in the metals sector. And some of the, so we were like, historically, we were over owned on Hindalco, Nalco, and copper sort of thing. This time we didn't have because we were not very clear how this trade war will affect the commodity prices. So anything related to which is more dependent on the global markets, particularly China and US thing. And we also have our view of dollar outperformance, and that led to a more conservative approach rather than participating in the region. That's the reason it has relatively underperformed the commodities index itself. So this is the reason, but it was a more conservative approach which we have taken, and hence this is the outcome. And
Sandeep,
QSIP part, okay?
yes, yes.
Okay. So I tell you, my personal view is this product is very new for the industry, and we have been practicing this product in the past also in our previous avatar when we should run our prop desk. Okay, and we are the biggest facilitation system on the street. The way globally wealth management or risk adjusted products are coming, or wealth. Well, I think the product which is the you will going to protect your downside, or whether you want to call it absolute return product or long short product or hedge fund, various name these product exist. They are actually doing quite well globally. And if you somebody has 10-year perspective, because in 10 years you will see at least two, three sharp up move and two, three sharp down move in the market. And this, if this product is able to capitalize that opportunity, if you ask me my personal view, because there is no data point to showcase that, logically, QSIP will outperform our mutual fund scheme from a 10-year perspective. But I will give, instead of looking at the outperformance, I will say the risk adjusted return in 10 years will be far, far superior than the mutual fund scheme because of a better beta management strategy out there.
Thanks, Sandeep. Maybe for the benefit of everyone, I'll just talk about that NFO is already open from April 2nd, 2026. It's closing on April 16th, 2026. Allotment date is 21st of April, reopening on 24th. Minimum is 10 lakhs. Any existing investor, they can put an additional of 10,000 rupees for this NFO also. And I have already shared the email, contact@qcube.com. In case you have further queries, you can write an email on that. Sandeep, you can conclude it.
Yeah. Okay. So I think the way we have explained you the multi-asset strategy is not like NFO is come. We are very vocal about it, our views. Okay. I think this is strategy where everybody should participate, and we have showcased our track record on the multi-asset side, how the mutual fund has performed very well, and it's not only 1 year, 3 years, 5 years, 10 years also the product is in. So, if 1 to 10 years perspective, any strategy has worked so well and beating the equity strategies, forget the debt. Okay, then obviously it's required some amount of pondering from your side and the very candid feedback. This is a category I will urge everybody to increase the exposure. This is a one of will this category should deliver the best risk adjusted return, not only on the mutual fund side, even in the QC side, even better. I think it's a great product, and everybody should try to participate in this thing just from an experience perspective. Thanks a lot for joining us.